Hi traders, welcome to Admiral Markets. My name is Chris. We're going to take a look at the strategy today on Wednesdays, of course, in this live webinar. But first of all, as we always do, two disclaimers. First of all, the webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out more information about that and to see if it is suitable for you. Also, please note that trading for exchange and global financial markets is considered high risk. Oh, there we go. Please seek the advice of an independent financial advisor for more information on that. This webinar is for information and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, first of all, let's take a look at the Admiral Markets website. You'll find out more information regarding how to start trading, of course, what kind of instruments are available, what platforms you can use, and besides MT4, nowadays MT5 getting more popular, so it's something I'm going to check out myself too, probably soon, maybe this weekend. And of course, analytics, education. There's a lot of things to discover. I know it's maybe a bit overwhelming at start, but sooner or later you'll get the hang of it, and you'll find your the spots that you find interesting. Perhaps that could be analytics, for instance, etc. So check that out after the webinar. Of course, today we're going to take a look at strategy. The focus today is trading supportive resistance and patterns on daily and weekly charts, like we did last week. So we have a little bit of a mini series on this kind of theme or this focus. So let's continue with that. Alrighty, there we go. This is the hourly chart. Let's kick off with the weekly chart. So we basically have a couple of days left before the monthly candle is closed. September would then be finished, and it would also finish a quarter, basically the third quarter. So Friday is a bit of a dangerous day to trade. Keep an eye on the fact that there could be some volatility because of the last quarter day. But otherwise, this weekend we'll have a new monthly candle to review. At the moment, your dollar monthly candle is looking bearish, but mind you that this candle is not closed, so we cannot use that info as yet. This weekend we can, and we'll see. Next week we can analyze it and just use that monthly candle for analytical purposes, but not yet. This week we had the two kind of indecision candles, but this week is showing some bearish pressure at this moment. And on the daily chart, you can see that Monday we talked about the breakout candle. Nennet and I we were looking at the euro dollar after the German elections on Monday, and one thing I said was look for a daily candle close near low on Monday as a signal for a breakout. So that indeed happened, and you can see that price has made the downside after that. Just give me 2 seconds. All right, sorry about that. I had two headsets on and it was a bit uncomfortable. All right, now I have one. That's better. So basically, yes, the candle low, indeed, daily candle low was closed near low. That was the signal, in my opinion. So why was that an important daily candle? Because of this break of this channel, basically. So we had a good uptrend channel. This daily candle closed, breaking that channel, threatening to break the horizontal level as well. And because it had a good candle close, I thought that that the particular support line would break this particular, if there was any left, this particular support. You could also draw it like this, so maybe it was broken. Whatever the case, continuation seemed likely. So as I discussed last week, one of the things we could do is put a fib and wait for the retracement, or trade the breakout, for instance. I specifically was looking for a 1 hour kind of bear flag pattern to 118. 50, 118.70, I said, or anywhere between 118.30 and 118.70, not above 118. It went to 118.60, right? But this is, if you're not trading a 1 hour chart, that is a bit difficult to trade on the hourly chart, of course, if you don't have the time. If you're trading daily candles, you could have put a pending order, perhaps at a 23.6 fib, put the stop loss above 109 or the candle high, and maybe have made already the trade and close the trade with it, take profit in the meantime. So that's how a daily candle can be traded. It's a bit easier in this case if you can look at the hourly chart, but not undoable with this particular candle to have a pending order and trade it further down, right? So this is an example of trading support and resistance patterns on daily and weekly time frames. It was a very good example, I think, what we discussed live pre-fact on Monday. It's easy to say retrospect, but mind you that this was a trading plan even before Monday's candle was closed, and you can see its execution in retrospect, but the plan was discussed pre-fact, right? So candles like this, I think, give a lot of information: highs, lows, closes, size of the candle, and we can use that information to our advantage, right? Um, so basically, candlestick patterns, all of this are very useful clues for trading. For instance, here, these wicks here could indicate reversals. Um, this potential correction here, right? On the daily chart, this breakout candle, very good for continuation. So stuff like this, you might not get the perfect entry, but I think it gives sufficient options to trade just when looking at this market structure and using pending orders. I'm not a big pending order fan, but if you base it on daily candles at the right spots, it makes sense. I have the time, in a way, the luxury to keep an eye on the charts and therefore be, let's say, shop around a little bit more, right? Um, and that's fine too. But if you don't have that time and you want to use uh, the daily, weekly charts, or you don't want to, but you have to because of time uh, aspects, then you can wait for critical kind of bounces or breaks and then place pending orders based on that. Whether they're with the trend breakouts like this or reversal bounces like this, you can use those candles. But you need to, in this case, do some analysis first, do some pattern understanding, patterns, market structure, etc. I know that it's popular probably to look for specific candlestick patterns based on X formula. But although it can work for a while, I'm a bit skeptical about the long-term viability of, let's say, this and this at this and this. Because although it's simple and therefore looks interesting, I think that ultimately trying to learn the market structure and understand what the charts are actually saying, what it's communicating, will give you more understanding than, when these three things happen, then take a long. It might work, and it might work for a while, might work for long, but I don't think that it's just still a bit limiting. It's still, if you just take all of the factors into account, especially if you trade daily and weekly time frames, you really have to look only at two time frames. There's not much multiple time frame analysis there, and if you just take the time to look at support and resistance patterns and trend, you can derive to a quick kind of outlook of what might be going on. Whereas if you, I know, simplify it to say I'm only trading pin bars at support or resistance. And on a daily chart that might work fine because it's a high time frame. It would not probably work that well on the hourly chart. The daily time frame that could be okay, just because of the sheer weight of the time frame. But ultimately, I think understanding the market structure has offers more, uh, like gives you more flexibility and more capabilities to tackle the trading. We'll take a look at some other examples soon. ZT has a question: when do you recommend to predict lower lows and lower highs price movements? I'm not 100% sure what ZT means with that actually. Well, generally speaking, it's better to react than to predict. But I'm not sure if that's what you mean. So I'm cautiously answering this question because I'm not sure if I understand it. But so with that I mean is instead of predicting, euro dollar is straight line down. I'm not sure. Yes, at this moment, price is making a lower low. We had a lower high already, but that was not yet a confirmation of anything necessarily. With the break of basically 105.50, right, this level, we have a lower low officially since yesterday. Not even Monday we had a lower low, but because of the break of the channel, we basically had a like a strong chance to get a lower low. Now we have lower low, lower high indeed. So from all perspectives, this is a downtrend at this moment, but the downtrend could be a correction, and the correction could still be part of a larger upside. Why? Because if you look at the moving averages, they're all aligned to the upside, and basically price could make a kind of corrective pattern here and move upwards again. Let me renew the template here a bit. All right. So I'm not sure if that answers your question actually. But from a prediction point of view, maybe what you mean is where are support levels where price could stop potentially, if that's what you mean. And we could use this fib, for instance, like this. And 23.6, 38.2 fibs could be levels where price stops, right? From this point of view. So when you have a trend in place, momentum in place, you can look for confluence and support and resistance to understand when price might stop, turn, etc. Let's take a look at this euro dollar in more detail. So, for instance, here we have on the monthly chart, prices in a bullish momentum. Weekly chart, prices in a bullish momentum, but is making a retracement at this moment. So we can use this fib again and say, okay, could there be a continuation of this trend? Could this be a correction indeed for more upside? And it's possible that could be the case. So we have to be careful with 23.6 and 38.2 fibs because that's where price could stop. If, however, this week's candle has a strong candle close like this, then the 23.6 fib is probably going to break and price will probably move down to the 38.2 fib. If, however, there is some wick on the weekly candle or we see a little bit of a bounce like this, there could be a response to this 23.6 fib, and there could be kind of a bounce, pullback, continue to the top like that. All right, and to test this resistance line like this. All right, so there's also a support zone in here. So this could be an area roughly around 117, 117.50, where on a daily time frame, price might make a bounce back up. And if it does make this big upside, it's making a corrective pattern. All right, in that case, it would confirm kind of the overall correction that could occur here from a pattern point of view. So what would we be looking for? If we see bullish engulfing twins, for instance, at this decision zone, right, that could be a trigger for upside to the resistance trend line, right? Because let's take a look at the factors. One, in fact, is that we're at support. Price is making lower lows and lower highs, but the pattern indicates that it could be a correction. And the overall trend from here, this perspective, and the moving averages is still up. So we're making a correction, a downtrend channel, but it could be corrective within the bigger upside. And we have support. And if you factor in the patterns, this 117, 117.50 is a crucial zone for a potential upside. But would you want to trade it here as a pending order? Sometimes yes. In this case, maybe not. I don't know. I'm not a big fan of pending orders, so I'm not a fan of pending orders like this. In any case, it's different if I use a pending order, for instance, at this breakout candle, and I set it halfway the breakout candle. That's okay. That's a bit better. Using pending orders at massive support levels like this, I'm not a big fan of that, but it's possible. In this case, I would rather wait for engulfing daily candle twins wait for maybe retracement halfway, stop loss below the candle low, and target the top of this retracement, this correction. That could be a trade, for instance, to the upside. All right. Downside trade could be at this resistance trend line. Wait for a bullish engulfing twin or some pin bar on the daily candle. And yet again, that could be a short, stop loss above that candle high, targeting the 38.2 fib. So those are just two trade ideas based on the market structure at this moment. Third idea could be basically if this week's candle closes near low, like this, then I would expect a continuation down to the 38.2 fib. Because typically when you have a good candle threatening like this, threatening support or resistance, the support or resistance level breaks. So if this week's candle does close like this, I would expect a break to the 38.2 fib. But there's one more factor we need to keep an eye on, which is the monthly candle. So if basically, this month candle closes as well at the end of this weekend. So anyhow, that looks bearish too. So it confirms the weekly. So we can stick to that plan. So I would personally, at the end of this week, when trading higher time frames, I would put a fib like this, wait for perhaps a retracement to the 38.50 fib, stop loss above it, look for the move down to the 38.2 fib there, right? Just based on the weekly candle. Or if price does not make the retracement up to the 38.2 fib, but for instance, we see Monday, Tuesday, two dojis, then could even place an order, maybe a breakout. I don't like breakouts on daily candles like this, but it could be okay in this context with a stop loss here, with a target here, a stop loss above this candle. If we get two dojis like this, for instance, right? So we get two indecision candles, clear support line, or even better, sorry, that was not my main idea. Even better, let's say we have indecision, and then we have a candle close below it like this, right? With a bearish close, do you see it? I don't know how well you see it, but bearish candle breaking below the 23.6 fib like this. All right, that's a bearish break below the 23.6 fib. Wait for a little bit of retracement of that candle to the 38, put stop loss above it, and target the 38.2 fib. That would be the fourth idea. So 4 trading ideas based on daily, weekly candles, market structure and patterns, support and resistance trends. So just basically market structure using these few tools. Does that make sense to you? I know that this, on one hand, might seem easy because I'm showing you my thoughts. It could be a bit more difficult maybe when doing it yourself, that I realized too. Thirdly, it does require kind of, as I said, a few more extra steps, a little bit more mixture of items, and it's not that kind of cookie cutter approach in a way that says, wait for a pin bar at the cloud with a Keltner, and I'm making this up just in case you're following this. I'm making this purely up. I'm just saying a very mechanical approach. Mechanical approach, yes, is pleasant because it kind of reduces our need to think about it. Easier to kind of maybe look at a lot of pairs like this. But once you get into the training of this, I know I don't want to seem like too repetitive on this, so apologies for that. But I just want to one more time emphasize that once you get into training with that and you get used to this, it will become easier, and I think it will be really valuable to understand the market structure. It gives you a lot more. I think a lot more. It gives you a better skill rather than the simplistic way of maybe finding entries on these higher time frames. ZT is asking, is it safe to presume if price breaks the 38.2 fib that it can go to the 50? Yes. There's just one kind of caveat, one question mark open in my mind. Usually I'm pretty sure about which fib to use. This particular time, I'm a little bit less sure, but I think it's still pretty likely that it's this fib. It could also be this one, but ultimately it really doesn't matter that much because the difference between, let me get rid of this fib. Here the 50 fib is at 113.30, right? And here the 50 fib is at 112.95. So there's like a 30 pip zone difference, right? With the 50 fib. The 38.2 fib, the difference is about also 30 pips. But more importantly, around the 38.2 fib is that 115 round level, psychological level. So anywhere, and when we're talking about levels on higher time frames, you have to kind of give or take a little bit anyhow. So when we talk about 115, what I basically mean is at the very minimum, I'm talking about a 50 pip zone between 114.75 and 115.25. So that's anywhere in there, price could stop, and it's actually respecting 115 and the 38.2 fib. For me, it seems a little bit funny if traders are looking at 115.12 and price breaks 1 pip below that level, and they think it's a breakout. I don't think that way. I don't see how you can even look at it that way, to be honest with you. Just because it broke by 1 pip is it's nothing on a daily chart, right? Maybe on a 5 minute chart, but maybe not even that, I think. But so I don't think the market is that precise. I don't think you can assume that it's that precise. And not you personally, but I'm talking about the traders who are thinking that. And I think that you gotta be a little bit more flexible in a way and see these numbers as zones, right? So that's a quick side note on that. Now, let's take a look at euro dollar is something we look at often. So why don't we take a look at a different pair and we'll analyze the daily and weekly charts there. See if there are any particular trades that could be interesting to trade. Does anyone have a particular currency pair or instrument in mind that we can take a look at? And by the way, if you have any, I know that I'm really focusing on this market structure. So, but if you have any particular question about tackling other types of styles, let me know. I will actually discuss a little bit about this Keltner indicator as well after this. In the meantime, as I wait for a particular currency pair that you would like to look at, pound yen, I got it, great. I do want to focus a little bit on this Keltner because if there's one indicator that I think has a lot of value is as a tool, as a standalone tool. As I just told you, I'm not really a trader that does that. But if I had to choose, I like this Keltner indicator a lot. It's from the MT4, MT5 Supreme Edition from Admiral Markets. It works a little bit like a Bollinger Band, but I like it a little bit more because it doesn't expand the zone as much. But it works well as a breakout or bounce indication. So we'll talk about that in just a second. Let me finish my market structure analysis or methodology. So let's take a look at pound yen. Let me clean up this chart. Let's zoom out to the higher time frames. Now, how much time you spend on each time frame really, of course, depends on everyone's schedule, how much time you have to trade, how much time you have to analyze, how much experience you have, etc. Right? You can make it really as long as you want, although in some cases, it depends. It's not necessarily better, but it helps maybe with your own confidence and your own learning curve in the long run. But all right, so pound yen. Oh, sorry. All right. Feel free to draw any particular trend lines and stuff like that. Not that these trend lines are really that relevant, but if you think that just to give you kind of more context, right? It could help you. That's fine. So you could, I don't do this every time, but you can see bounce at support, break of resistance, and of course, most recently, price making kind of a flag like this or triangle in a way, and potentially breaking that to the upside. We will see that a bit better on lower time frames, in fact. And you can see how price probably even bouncing off a 88.6 fib. Now this is all information from the past, but it could give you an idea that maybe price can get up to the minus 272 target if it makes, for instance, an ABC correction like that. Something to keep in mind. In any case, price might retest the opposite 88.6 fib. If it's a triangle, that could be a conservative thing to look at. So price could get up, for instance, to these zones here, right? And if that happens and price stalls there, price might make a triangle like this, right? A lower high and a higher low, something to think about too. So these fibs could be stalling spots potentially. We could keep that on the chart just to get an idea. Now, weekly chart. All right, we see basically momentum and we see the ascending wedge that we talked about in the past as well. Why? Because we have a flat top basically. I should use red for that. Flat movement here, and we have higher lows, right? So it's a little bit like an ascending wedge. Prior to that ascending wedge, we had momentum to the upside. So if we measure that pole from top to bottom, it's about 2,400 pips. And if we add that 2,400 pips to the start of the next pole right here, we will get up to about 163. 163, which falls around here. So that would bring us to the 50/61.8 fib in that case, if this is equal, right? Like this. All right. So more info. Well, we had basically 2 weeks ago a break of that wedge with a good bullish candle, strong candle, big candle, candle closed near the high. All right. We can also put a fib on this swing high, swing low, and look for targets, right? But yeah, not really adding that much info for the moment. All right, so let's take a look at anything else to discuss here. So let's take a look at, let's see, anything else to discuss? I'm just double checking if I missed certain angle. It's good to look at the oscillator, good to look at divergence, by the way, not that we have it here, I'm just thinking about angles that we didn't discuss. Moving averages, is price moving back to the moving averages or away from the moving averages? Those are things you can think about as well. Let's take a look at the daily chart now. There we go. All right. Good. So we had basically in this pattern, we were looking at price to, I think here, to make a downside towards the bottom, right? Just to give you maybe some historical context trades, and then we'll take a look at now. What kind of trades could have been tradable in the past, and we'll move on to the future, right? So when price, for instance, was making a bounce here, right? Not that this could have been a reversal trade, but I don't even want to talk about that. It's riskier, perhaps. What could have been traded, for instance, was the weakness here, right? We have double top, we have a strong resistance trend line, we have momentum, we have a kind of a corrective pattern, and then the engulfing twin kind of confirming that potential turnaround. So we can put a fib on that particular candlestick pattern like this. And you see 38.50 fib zone and price moving to the bottom of that correction, right? So roughly speaking, or at least to the fib targets. So that could have been one way of trading that bounce. All right. Then we were talking about basically, sorry for this back and forth. about the potential for price to move back up to the top, right? Price was in a momentum, but we didn't know how far it would go. We had 5-6 days not breaking this bottom, price making momentum to the upside, and then making a bull flag. So another way to trade that could be the breakout, like this, right? We have a flag. All right, so this could be the breakout candle, for instance. Or we could try to trade the flag itself, right? By trading, for instance, the fibs down in here, or the reaction to those fibs here, and then taking a pending order there for the potential move back to resistance. So those are some historical context trades. There you go. If we're looking for the initial reaction to support, because we think that this is a correction, even these bullish candles right here could have been thinkable, right? Just to give you some ideas about trading the market structure. Sorry. Good. So let's move on to now. So we had the break. We're seeing also some kind of correction at this moment. Let's get rid of this. This is the daily chart once again. So from my perspective, this is a very strong momentum on the daily chart. So it looks like this particular bearishness could be a correction. So I think it would make sense to put a fib on this particular strong move up and wait for basically price to make a retracement to the 23.6, the 38, or the 50 fib. I think a shallow fib makes sense because of the strong momentum and the breakout. So we have also here, we have historically broken resistances. So that would be the last kind of support level I would expect, basically, right? And if we keep in mind also the bigger context, which is basically still saying that this is a momentum, this is a correction, and this is potential momentum up to the 50, 61.8 fib, and maybe even, as we said, to the higher fibs, potentially. We see that there's plenty of space. Now, we have to keep one thing in mind, is the 38.2 fib. And this could create some kind of correction, potentially, which is why also we wouldn't be surprised that price might make it down to here before it moves up. So from this perspective, I think we can look for two things. We can look for the retracement down to the 38 or 50 fib, 147, 148.30. And I wouldn't use pending orders. I would use basically, I would wait for price to get there and wait for daily candle confirmations in that zone. Then either trade the candlestick confirmation or trade a retracement of that candle and then take an entry there for upside. The second idea could be to trade, for instance, here, the break above the 38.2 fib. So we have 151.10 as resistance. We had a little bit of push of here. We had a small push here, but on the weekly chart that turned into a wick. So I think that if we get a new candle that is able to break above R1 and the top around 152.50, I think a candle close above 152.50, so a strong bullish candle like this would also signal the upside continuation. All right, in that case, we had a little bit of a small pause. The 23.6 fib was enough to send it higher. And if we get a candle like this, would look for a little bit of retracement, maybe halfway that candle, but the stop loss below that candle and look for continuation. This breakout candle, though, has to be pretty sizable. It has to be, not a small candle. I would like to see it probably at least 150 pips, I think. Let's see if it's tomorrow's candle and it starts here. It's 151. Yeah, 150 probably for pound yen. This is, of course, currency kind of perspective in relationship to the average candles that you see on the chart. If for any chance this week, because this is candle, if we use time pattern, this is candle 1, 2, 3, 4. So if this week 5, 6 candles now break this high, we will probably see a bigger correction like this, and I wouldn't be surprised if price gets down there and then moves up again. So now you have a little bit of idea when I'm interested in a breakout to the upside, when I'm not interested in the break to the upside after 5 to 6 candles. When I'm interested in trading it, here in this zone, or which zone, when, after some reaction to that zone, and where I'm not interested in that zone. That would be if price is showing bearish candles continuously and pushes through the 50 fib, because if it pushes through the 50 fib, it invalidates, in my opinion, the setup. It doesn't necessarily invalidate the upside entirely, but something else is happening. Something else is going on. So I would kind of reanalyze it and be more cautious again. So yeah, that's basically the pound yen. It's really a game at this moment. Price is really, I think, from my point of view, facing the 38.2 fib and has to decide whether it has the power to break through it immediately, or will it, with a fib, cause a reaction, a retracement that will go back to these fibs, which should also create a continuation of this upside. So this is, in my opinion, the most likely path of least resistance. But we also right away know that we know the levels that I have in mind that would invalidate this, right? A break above 152.50, immediate upside. A push below the 50 fib at around 147, then we're not getting the bounce. So yeah, that's basically it from these higher time frames, I think. Let's see if there's one question actually. I only see it now. How do you see on the candle if it closed strong? So that's a great question, and there is a pretty specific answer for that, in my opinion, which means basically you gotta measure the candle size from high to low. So let's say that's 200 pips. So let's take this example, this candle here. Right here, this one. So the high-low difference, in fact, is about 270 pips, a little bit less, 266, but doesn't matter. Let's say 270 for just to make it easy. The candle high is, one second, I lost the info there. Okay, the candle high, then we measure, because this is a bullish candle, so we want to know how strong is the close. So we need to know the difference between the close and the high in this case. So with the bearish candle, and we want to measure the strength of the bearish candle, we would measure the difference between the low and the close. So in this case, there we go. Let's see, the difference is about 21 pips. So we would take the wick on top of the candle, which is 21, and the total candle, which is 266, as we know, and divide it. So 21 divided by 26 is a percentage. It is roughly, it's less than 10%, because 10% would be 26. So it seems to be about 3/4 of that. So it seems to be about 7.5%. It's not precise. Could be less or a little bit less or more, give or take, but about 7.5% is that wick. So that's a very precise answer. But how do you measure that? How do you use that, right? So there maybe a bit less precise, but still pretty precise. Anything between 0 and 5% is excellent. Anything between 5 and 10%, or actually 0 to 5 is superb, 5 to 10% is excellent, 10 to 20 is very good, or 20 to 25 is good, 25 to 30 is okay, 30 to 35 is so-so, and anything more than 35 is really not so good and doubtful breakout, or a doubtful candle close. Anything more than 67% wick is maybe even a potential reversal, depending on the context. So anything really between 0 and 25% is very good. 25 to 35, sorry, is gray area, and 35 to 65 is not so good. 65 more is is not good at all. It's more reversal kind of territory. So this 7.5% is a great candle. So this is a great candle for the bulls. It shows that the bulls have stayed in control. So of course, there will not be trades using market structure every day on one pair. Of course, uh, it depends on the structure and stuff like that. There could be some scale-ins, for instance, possible. If you're a bit more aggressive trader, it is possible to think about things like that if you feel confident in that. For instance, let me see if I can find an example here. For instance, let's say we just this momentum, we assume that there will be a continuation, so we put a fib from here to here. This is just hypothetical. We see a bounce at 78.6 fib, and we take the candlestick bounce right here, right? We take this candle, the bullish reaction to the 78.6 fib. And our target is a conservative target. We're aiming for, we flip around the fib like this, and we aim for the 88.6 fib or the 78.6 fib. So that trade is going on, but what if we want to trade it again? So we, for instance, put a trend line like this, right? And we see a breakout, and this might be a pullback for continuation. So we're analyzing, we see 1, 2, 3, 4, 5, 6, 7th day is bullish right here. We're still not sure about this candle, so we wait for a candle close above these resistances like this, and that could be this candle, for instance, or even this candle. So that's tradable. We could take that. I'm not a big fan of scaling in, but on daily charts like this, you could move the original trade from here and the stop loss from this particular stop loss below this candle low to this point to reduce the risk on the first trade, and then take the second setup here or here with the stop loss probably below the same spot, maybe even below this candle, a more aggressive stop loss, and aiming for the same level, right? 2 scale-ins, 2 trades. A more aggressive trader might even think about putting a fib on this strong candle, for instance, waiting for a fib, put the stop loss here of the first 2 trades, which means that the first trade is already in profit, the second trade is break even, and the third trade is entered here with again the same target. And at this target then 3 trades are closed, for instance. So don't get me wrong, this particular scale-in style is not good. I mean, no one should do that, of course, when using max risk on each trade. You have to take into account the risk you want to take in total as well, not only per trade. If your max risk you want to trade is 3% at any time, then you would maybe take 0.5% risk on any of these setups. So the total would be 1.5%. And also, of course, mind you that if the first setup, the stop loss is moved for the first setup, that means that the open risk is less. You could take that into account too. You could say open risk max is 3%, but if the stop loss has been moved so that the risk on that trade is less, then I will count that I would count that particular risk as less important. So you would maybe say open risk is 3% max, but open risk and risk that is where the stop loss is removed, the total of that could be 6%, for instance. Just to give you, I'm just working with random numbers here, right? So that this particular trade does not weigh in because it's already almost at break even, does not weigh in on future trades that much, because justly so, I think because you have that trade already at break even almost, or sometimes you do, or sometimes you have a little bit of profit, etc. All right, so I'm not saying that every candle should be traded like that. Not every candle of this candle should be a scale-in. I think But in certain situations like this, for instance, it could make sense. All right. Regarding the Keltner, let's see if we could find maybe some interesting chart for that. We could maybe use the pound dollar for that. All right. So just to focus a little bit on the Keltner, it does give great bouncing spots. Fibs are something that does take a little bit of time to understand what are good swings. Fibs are very connected to swings. So they're very connected to impulse, correction, and understanding what is one swing. That's why I think fibs are a bit difficult for traders in general. A bit easier for traders that use patterns, specifically wave patterns, because they're used to looking, they have a kind of they have a fixed methodology, or they should have, to identify impulse and correction. Not every wave analyst has that, by the way. That's why some wave patterns are not that great as others. Uh, Good wave analysts have a fixed way of identifying impulse and correction, right? And if you have that, then fibs become easier too. If you don't have that, fibs is more difficult. I have a fixed way, and I can tell you what it is. It's based on the Osmo oscillator, all right? And that's a very key factor to not only wave patterns and waves, but fibs as well. That's why I think a lot of traders do struggle with fibs, although it is, from my point of view, probably a very popular tool. All right. So, but the advantage of Keltner is that there is nothing to learn about it, right? It's automatically plotted, so it reduces the learning curve. That's great. So when price reaches the Keltner, bounce or break spot basically. So if it fails to close above it, if it fails to have a good candle above or below it, in fact, I should say, then it could be a bounce spot. Once you see a good candle push through it, it's more likely a break spot. So let's take a look at a few examples. Here you see most recently a good breakout candle. So that could be a good breakout for continuation, right? So based on that, you can see retracement of that candle, stop loss below the breakout candle, while the target, I guess you can pick, and that's a good breakout trade, right? So that's one way. Other way is here, when it fails to break, but then shows a bullish candle after failing to break through it. So that's a bounce. So this could be a bounce trade. So I don't necessarily like, as I said, simple mechanical approaches. On higher time frames, they generally speaking do okay. And the Keltner, I think, is one of the better indicators for an approach like that. And the Keltner is a good kind of decision zone for making potential trade setups. For instance, here we had a breakout, but mind you that the candle, although the candle close was above the Keltner, the majority of the candle was not yet above it. This is different here, where half the candle was above. In this case, not. So it could be a breakout, but maybe a breakout that would see a retracement. And that's indeed what we got. But after retracement, we did get a new continuation higher. Here, for instance, we had mind you, the second push up like this could see kind of a retracement. So indeed, when you get bearish engulfing twins like this at Keltner, get a good downside. So those are all potential trade ideas just based on Keltner. And once price closes back below the Keltner, like here, it could also indicate weakness and a potential correction, which it did as well. So this is how you can use Keltner, and just a few ways, or the most important ways probably, and how you can use candlestick patterns at Keltner levels to make potential decisions. Is there anyone else that has a particular pair in mind? Otherwise, I think any questions regarding Keltner or market structure? Do you find it? Do you use it yourself? Do you use market structure principles when analyzing the chart? And do you have any difficulties with it? Anything you struggle with? Now would be the time to ask, because I gladly help. Next week too, we still have a focus on this topic the last time next week. So let me know if there are any questions that pop up in your mind right now. Maybe a last look at the dollar yen, for instance. Alrighty, here you can see how, a failure in a way here. Not a failure, but for instance, if you would say, okay, price is at the Keltner, at resistance, there's a bearish candle, that kind of confirms the downside. Well, that would have been a loss, wouldn't it? And I'm not saying that losses are part of trading, right? One thing that could have been a bit of a clue for you is that the big wick at the candle, this wick here of this daily candle, would probably keep you out of that trade. But the second candle might have confirmed the downside to you. And that would not have been a strange thinking. So those things happen, of course. Now, this bounce here at the bottom of the Keltner was a good trade, wasn't it? This bounce was an okay trade, too. Here, not so good probably. We had a downside before upside. Here, good trade. Here, not so good. Price went sideways. Here, good trade. Here, breakout candle, still a push up, okay. Engulfing twins below the Keltner, good trade. Engulfing twins here, not so good. Downside before upside. Engulfing twin, pin bar, okay trade. So, it's a bit of a mixture. And obviously, here we have bearish pin bar, good trade. But obviously, if you, I think, use a bit of a filters, a bit of analysis, I think, generally speaking, most of the time, it should be possible to improve these stats. All right. 2 questions, great. No problem regarding basic questions, not at all. What are the little lines on top and the bottom of the candles? I'm new to this, but it's great. Well, that's very glad to hear that. And the thing is that there is a bit of a learning curve to that, but the advantage is that you're really learning a skill. It's like a language. So once you learn it, you can understand the communications of price and the chart a lot better. So it's really worth doing. But to your question, what are the little lines on the top and the bottom of the candles? Those are wicks, actually. Sorry, now I got it. So let me clean up this template for you, so nothing is disturbing us from it. Let me remove everything otherwise, just quickly. All right, there we go. So what you're looking at are candles. There are a few ways of looking at candles, at price, sorry. Range bars, Heikin-Ashi candles, Japanese candlesticks. These are Japanese candlesticks. Open and high bars and line charts. These are Japanese candlesticks. What you see here is high. Sorry, this is a high. This is the low. And we see the open and close. Or with the bearish candlestick, it would be the opposite. This would be the close, and this would be the open. But the high and the low stay the same. So you see within this candlestick, this is a daily chart, so it's a daily candle. You see the parameters of that day. You see where price opened, you see where it closed, you see the intraday high, the daily high, and the daily low. So it gives you information about the battle, the struggle within that day, but also who won and who lost, and it gives you information. If you're talking about this at the bottom and the top, those little lines on top, that's called a wick. And the wick is basically everything what is above the close or open and below the open or close. It shows that there was intraday pressure within that candle to the upside and the downside, but price moved away from it. So at the open, it probably moved down, and then it moved up, and then moved down again to close here. So it opened here, it closed here, and of course there could have been more ups and downs, but the wick shows basically the intraday pressure. So if there's a wick, that means there is kind of weakness. If there's a strong candle close, it's strength. Like this is a good candle close, little wick on top. So that means that the bulls were in control. They didn't lose control at the end of the day. But for instance, here we see the bulls control the candle and that the bears lost control. Look at the wick here. Here we see that the bears lost a little bit of control because the wick was at the bottom. So they didn't really control that day till the end. Here the bears did control the day towards the end. They kept control. Yeah, Robert, yes, indeed. Oh, I missed your question. Sorry. I see now that it's split there. Could you elaborate the relation between market structure and pivots? Pivots in the sense like important spots, right? Or pivot points specifically. I think you mean important spots. Can you elaborate the relation between market structure and pivots, searching for an entry? Because you seem to consider both sides of a trade when price approaches an important level. Indeed. Mostly yes. It does depend about the space, what I expect. So not always, though. So to give you an idea, when I might not want to trade both sides, let's see. Or I would be holding off for that. Let me think. I need to think of some situation here. Example, first of all. Let's see. It's true generally though that important levels will have both sides, but let's say we're at a minor level, right? Then I would not want to trade at both sides. Let's say that price is in this momentum, for instance, like this, and we are after this candle, right? So at this moment, there might not be really a bearish trade that I have in mind at this point. We just broke a bear flag, sorry, bull flag, excuse me, like this, right? And we have a bullish candle. Even if there's an engulfing twin, I would probably not trade that, just because of the fact that in this case, let's take a look at the bigger structure. In this case, this could be, I'm expecting actually price to make a bigger C wave like this. And considering the momentum here, for instance, I would expect this to be just a slightly deeper correction, maybe to the 38.2 fib. And if there's an engulfing twin, I would expect the next day just to tag the 38 and then bounce to continue higher. There's so little space here to the 38 that I would not want to trade that on this time frame at least, if you see what I mean. So here my vision is bullish in this case. and we'll be looking for either, if we do get a bearish engulfing twin, for a move down to the fib and bounce. We don't, we get a bullish candle, we get a retracement. This could be an entry, in fact, and we get a continuation, right? But hypothetically, if we would have gotten that, just to give you an idea. So minor levels like this, like this fib or this channel, basically, I wouldn't want to trade necessarily both ways. It's a bit different with when price does get to a zone where it's interesting in both directions. For instance, the euro dollar, it is interesting in both directions because of the fact that in this case the uptrend might continue here to 23.6 fib, but it could easily continue with the current momentum down to the next support zone. So in this case, yes, I would be interested in both sides. But for instance, here with this flag, right, we have bearish engulfing twin here, or maybe not a twin, but we have a bearish candle here. Let me show it to you a bit better, this one. I was not interested in that downside because from my perspective, trend is up, bull flag, break of the bull flag, and I'm not interested in trading it. One might think, okay, this is maybe a false break and it could go deeper down before it moves up. But no, I would not be looking for a downside trade here. I would really only be looking for upside. Does that help a little bit? I'm not sure if that answers your question, actually, but that's how I thought you meant. That's what I thought you were trying to ask. Okay, perfect. Volume is not so used in Forex as other kind of instruments. It's not that used. Oscillators are used more. For instance, oversold, overbought indicators are more used. It is, yeah, I know. It is a little bit more difficult, unfortunately, and it is more of a skill to learn, and will take some practice, indeed. So I'm sorry for that already in advance, but I think that you might be able to simplify it a little bit if you take, for instance, the Keltner as kind of your first viewing point. It's like a filter. If price is not showing anything interesting regarding the Keltner, it's like a filter. So you kind of quickly see which pairs are interesting, and then you start to analyze it a bit better. That could make the process at the beginning maybe a little bit easier, because otherwise, where do you start, right? It could be a bit difficult. This could be a good starting spot, and then you can filter out the currency pairs that are interesting, and then do a little bit more homework after that. Well, for me, the Keltner is not that important, as I said, but I was trying to find like a bridge for traders that are beginning with learning the market structure, if you see what I mean. So often you have an end goal in mind, but by using kind of a shortcut at the beginning, it kind of simplifies the way to learn and to get to the end goal in a way. So that's what I meant with Keltner, focusing on the Keltner at first. I don't focus on the Keltner. I just use it as a supportive tool. It's not my first focus, but I do think it's a very useful tool for, as I just told you, for breakouts, for failures to break, for moves back into the Keltner. So generally speaking, I do use it in that role with that purpose, but it's just not, let's say, the first thing I look at. So the reason why I mentioned that is just like because it's like a bridge. I think it could be a good way to learn to understand the market structure quicker, or in a way to also filter out, because there are 25, there's so many currency pairs, so that one can find the pairs that are more interesting at that point, in a way, if you see what I mean. All right. Well, I appreciate the fact that you were here and made it all the way to the end. I think that that's great. I think that it shows your willingness to learn market structure, and there are not many traders out there that are willing to do that. So I think that if you use this, look at charts, look at past price action patterns and stuff like that, and really build a data bank of the past by looking at patterns and practicing with this. It really will help you with experience, and you will see these things repeat, and it will give you more confidence and more awareness as well. So great job for being here. And if you're interested in more info from Admiral Markets, of course, please feel free to check out this page, admiralmarkets.com, and click on any of these tabs to find out that info that you need. Start trading, products, platforms, analytics, education. You'll find more webinars, of course, tomorrow, in fact, and next week. We'll be back, and looking forward to seeing you there, and wish you all great trading. Cheers.